Here we are again. If we're on an airplane that we call the economy, we are circling the airport for the umpteenth time with our seats in the upright position and tray tables stashed. Will it be a soft landing or will it be a hard bounce on the runway? Those are some of the questions today on Global Sourcing Insights from CIPS. I'm Bob Rossback. With me to talk about which way the economic winds are blowing are our regular guests, Dr. John Glen. He's a visiting fellow at the Cranfield School of Management, Cheshire, England. Dr. Glen is a frequent expert contributor to CIPS. Welcome, John. How are you today?
I'm very well, Bob. Glad to be here.
Excellent. And here in the U.S., I want to welcome Dr. Jason Miller, professor and interim chair of the Supply Chain Management Department at the Broad College of Business at Michigan State University. Miller's specialty is trucking and logistics. He's a frequent commentator in the national media on supply chain issues. So welcome, Jason. Good to have you here.
Hey, thanks so much for having me, Bob.
Good. So we are in a potential cry wolf situation here, as we've been hearing about imminent danger to the economy for well over a year. So perhaps we've just become desensitized because the economy has not tanked yet. But one of these days, maybe it will, who knows? So even though the task seems daunting, we are going to dig in a bit to see if we can help procurement professionals plan their strategies for the immediate future. Before we begin, I encourage attendees to ask questions using the text Q&A function. This is complicated stuff and we have very well qualified panelists, so please take advantage of their availability. We will answer some questions as we go along. However, even if your question seems to be a bit off topic at the time, we will try to get to it before we close the session. So let's start with that bugaboo called inflation. So Jason Miller, you've taken a look at some inflation data. So why don't we call up that first slide of yours, looking at inflation data, and tell us what you think, where are we heading, and how close are we to stasis,
Yeah, and really it comes down to right now, how do you measure inflation? Because there's multiple different metrics out there. There's the well-known consumer price index, still running in the high threes on a year-over-year basis. That's shown on the chart on the left in black, which is higher than the Fed's 2% sort of long-run inflation target. You have the Fed's personal consumption expenditure index that's derived from the BEA. They tend to focus on that a little bit more. That's still running high. But then a different way of measuring inflation, is often called the European way here in the States, is what's called the Harmonized Index of Consumer Prices. And that removes sort of a controversial piece called owner's equivalent rent that effectively charge people who own houses so they're in their house. And that series is shown in left on the red. And the key thing with the Harmonized Index of Consumer Prices is that's actually showing we're very close to that 2% year-over-year target. And that index increased far more rapidly in 21 and the first part of 22 because it puts more weight on food and energy. But as we've seen, those prices essentially come down on a year-over-year basis. We've seen, I should say the rate of growth has slowed on a year-over-year basis. We've seen the HICP look a little bit better. Now, on the good side, if we track inflation across the supply chain, the Bureau of Labor Statistics does this through the Producer Price Index program. What we can really see is a dynamic on this chart on the right that the price for final demand goods is up roughly 25 to 30% since before COVID, but we're mostly flat year over year. We had a spike up in September, but that's price to energy. And when we look at where those prices likely to evolve to, that orange series is showing what are the input prices for those final demand finished goods producers. And those prices, again, they're up 30% from before COVID, but they're flat year over year.
So
if
those are, I'm
even
sorry,
further
those
up,
are those are basically tier one prices?
So those are prices tier ones are charging
Are
final
charging.
demand producers. Yep. And if
Okay.
we think then about what are the tier ones prices, that's shown in blue as the inputs to stage 3 manufacturers, as the BLS calls them. And those prices are actually down right now from where they were last year because we're seeing reductions in pricing of plastics and plastic resins and primary metals, as an example, like steel. And so when we look at the likely inflation scenario for goods, is now that we're moving, it seems a little bit past this energy shock that we had in August and September, is that we basically continue to be flat right now, which is encouraging from a standpoint of keeping those goods prices from starting that, sort of reinflation again.
This sounds like pretty good news for procurement people who are on the buying end of all these prices.
No, it does. I
I
mean,
mean,
we're
stability is always better than volatility, and that looks like that's kind of where we're headed with at least some of the input stages, right?
Yeah, for the most part, again, on aggregate, we're starting to see a substantial normalization. I mean, the COVID, the 2021, 2022 cost shocks that we saw, which are, again, primarily due to commodity price booms, a little bit the Texas deep freeze causing so much chaos in the chemical sector back in February of 2021 has all contributed. But demand has cooled, prices have cooled, and then the prices for these inputs are starting to either level off and or actually come down in the case of steel, chemicals, plastic resins, etc.
Okay. All right, John Glenn, let's go to your slide here because we're going to do dueling decks. So what have you got for us?
So the story is pretty much continued here, and it's illustrating some of the points that Jason was making about commodities. So if we look at gas price inflation, which we tend to be consumed with here in Europe, now gas is the gas rather than what we call petrol over here. So not to be confused with what you guys put in your cars. Okay. Gas price spiked with the Ukraine war. Obviously, the rupture of the major gas pipeline between Germany and Russia, and therefore we saw that enormous spike middle of last year. That has worked its way out. Gas prices are back down to where they were, if not slightly lower than before the Ukrainian war started. And this is primarily due to alternative sources of gas. Major producer in Europe is Norway. Restrictions or reductions in consumption. We got away a little bit lightly last winter with quite a mild winter in Europe. So we're seeing that gas price inflation go. This was a chart into May of this year, and that gas price inflation has worked its way out of the system. If we go to the next slide, which essentially shows that the gas price reduction has continued into the back end, into Q3 of this year. So Manny, if we could move on one. Yes, so the decrease has continued into the rest of the year. If we go on again one, we saw a similar pattern as far as this is West Texas Intermediate oil, a spike again with the Ukrainian war, that being normalized into the middle of this year. But then we saw some upside risk in the early part of the summer, primarily due to output restrictions in Saudi Arabia and Russia, trying to force the price up. And then that's been exacerbated by the recent conflict in the Middle East. Interesting that Jason is calling that we might see that abating into the end of this year. That's something that we've got to wait and see, I would suggest. Again, Mandy, if we move on. Yeah, so that upside risk has actually appeared, and we've seen into the back end of this year increases in prices. So if we continue again, I want to look at I think it's agricultural prices. Surprisingly, because we have a significant household inflation, cost of living crisis, as it's labelled in the United Kingdom at the moment, and in Western Europe, where the narrative is that this is all about food price inflation. But what you can actually see is if you go from August 22 and take the index where it was relatively high, reflecting, increased grain prices, increased agricultural commodity prices. We see that those prices, if we look at meat, we look at dairy, cereals, particularly, which obviously were impacted particularly acutely by the Ukrainian conflict. We see that inflation has worked its way out of the figures, with the only exception being sugar. Okay. So,
Excellent.
if we then move on, we're back with Jason.
Yes. Okay. So, Jason, do you have any other reactions as you realign your headset here? All right.
So, do you want me to take this? So, we had a conversation last week when we were prepping this session, where obviously what we've got now is we've got the Fed rate, we've got the Bank of England base rate, hopefully peaking in the UK 5.25%, probably going to go to a max of 5.5, and then we're going to get reductions in interest rates, but I don't expect them to happen until the back end of next year, and if we get them, they'll be minimal. We're talking about sort of midterm interest rates in the United Kingdom, but probably no lower than 4%. Jason, if you're back, do you want to talk to your slide?
Yeah, no, exactly. And just echoing what you were saying, John, is, putting interest rates in perspective, the 5.33% we're at right now in the U.S. is not unduly high. We had a very strong period in the 1990s with the economy from, let's say, 1996 through early part of 2000, where interest rates were at this level. So, and again, though, folks hoping for a 2.5% terminal, that's not happening anytime soon. I think we're looking lowest of the low around 4. So, mortgage rates are not going to be down to 3% like they were back in 2021. And so I think that as we keep in mind how this is likely to affect investment, hurdle rates are going to be higher today than what they were in 2021.
Okay, can we go to John's? You've got a couple of slides there.
Moving on, Mandy.
So here's what you're saying.
Yeah, that's exactly what I was saying. So you can see the peak rates, and now we're looking across Japan, India, Brazil, Mexico. South Africa is obviously in there to make everybody feel better about themselves. But I only say that because my very close colleague is working at University of Stellenbosch in South Africa. So, guys, what we've seen is the steady increase in interest rates. I struggle with the stepped increase. Our central banks are charged with keeping inflation at 2%, but taking a long-term view of where they believe inflation is going to be. So I struggle to understand why they increase interest rates in 1.5%. But anyway, that's the road to how we got here. Looking forward to where we're going to go. I agree entirely with Jason that if we're going to see reductions, probably going to be into, I can't see anything much before the back end, middle back end of next year. And if it occurs, it's going to be very, very limited. And essentially just to show the end of the sort of cycle in terms of the battle against inflation. If we just move on one.
Sure.
And this was just an attempt to illustrate the impact that higher interest rates are having in the economy. This is a monthly direct debit failure rate. Just to explain direct debit, if it doesn't translate into the States, this is an amount that goes out of your account every month automatically to pay typically a series of bills. What we've got here is electricity and gas, fitness facilities for some reason, loans, mortgages, and water. And it's keen to say, there's the headline figure, when you look at the data in the UK, is, there's been a 13% increase month on month in default on direct debit, but most of that is actually because people aren't renewing their gym, or they're forgetting to renew it. They're just allowing the direct debit to lapse, which is not a great way of doing it as far as your credit score is concerned. Interestingly, direct debit failures on loans are pretty level. Okay. The one worrying factor there would be that the rate of default on electricity and gas, although well below 1% of all direct debits that exist, has probably tripled or more than tripled, okay, since the level it is at pre-COVID. So we are seeing some pain there, but I would say that the middle classes are in rude health, with the exception of the fact that they're defaulting on their fitness regime.
Yeah, their health is suffering.
Yeah, so I think that the underlying thing there is that the middle classes are relatively strong. Okay, they might be under a bit of pressure from interest rates at the moment, but they're surviving. The only difference I would point out between North America and the US, in the UK, is that typically we don't have fixed rate mortgages for the term of the loan. And we have a lot of people who are on a fixed rate for between 2 and 5 years, particularly 2 years, who will be coming off very, very low interest rate 2-year fixed deals onto exceptionally high variable rates. And even if they want to fix it, they might be coming off a 2.5% fixed rate onto a variable rate, which could be 5.5%. Okay, so those people will be hit, and there is an amount of fear in the UK economy at the moment that will cause this, hard landing that we're talking about today. Anyway, moving on.
Okay, well, so the question on interest rates is now how we're talking to procurement professionals, and how might interest rates be affecting procurement decisions? For instance, are we assessing the cost of keeping inventories? How should we factor what we know now about interest rates or our projections? How is that affecting procurement decisions? Jason, what do you think?
Yeah, so obviously higher interest rates mean higher holding costs, and probably even more significant than higher interest rates is just the inflation in material costs. If you think basic economic order quantities, if the value of the item goes up and your carrying charge goes up, that means average order quantity should be decreasing, all things equal. And so as we're thinking about, these decisions right now, if you're ordering something in a less than truckload quantity, and let's say pre-2019, you were ordering 2,000 pounds, you're probably looking now at a EOQ that's a little bit below that, having to, again, counterbalance transportation costs being higher. So you do have the counterbalance there. But I think as well, I've never liked this just in case inventory argument. To me, that's always been ill-informed discussion, and that there is no just in time or just in case. You just size safety inventories based on the uncertainty of demand and lead time. But the higher interest rates, the recognition that, hey, it's costing more to carry this inventory, it's going to put the pressure on companies that have excessive stocks to start to dwindle those down, because you're paying more for them than you were back in 2021.
So in higher interest rates kind of accentuates the bullwhip effect, in a sense, where we were concerned because we had shortages, so now we overbuy to have just in case, and now we have a lot of stock, and now that's going to cost us more money because we have higher interest rates. So in other words, it kind of accelerates or accentuates your strategies from switching from just in time to just in case, or vice versa.
Yeah, no, and we're seeing that. So many sectors right now are going through the most pronounced reductions in inventories that we've seen in a long time. And that's been particularly sensitive in, say, building materials, a sector that did a total whiplash between 2021 and the first quarter of 22 versus the back half of 22. And so part of the reason that just in general, manufacturing output and freight activity took such a steep drop was not only did we have less demand, but we had this inventory correction cycle that also had to take place.
Okay. So, John, chime in. Do you agree with that assessment, or do you have some other perspectives that we should consider?
No, I think that's exactly on the money, and I think therefore, calling a recession when essentially we're seeing this sort of significant inventory adjustment cycle that Jason referred to is probably a lack of understanding of the fundamentals of what's going on. And I think Jason explained perfectly, the impact the interest rates are going to have on procurement professionals in terms of, that optimal inventory that they must hold. And I really like his, as somebody who's used the just in case label, I really like his notion that, I always say this is procurement as it always was. It's just a different set of conditions, a different set of risks, a different environmental context, and the role of the procurement professional is to take account of all that and optimize the holding of inventory, so that their organizations can operate effectively. So nothing ever changes except the context in which except the change that you have to face. Okay,
The principles still apply.
Principles still apply. Yeah.
Excellent. So, what does this mean for the overall economy? The situation in the U.S., as I recall, we have aggregate numbers for the U.S. GDP for the third quarter. I think the current estimate is around 2.1%, and that's a level that it's been hovering at for several quarters. So, the first question is, has the Fed actually landed the U.S. economy? Jason?
Nope, we're not. I'm not going to consider the economy landed until the FOMC feels they can start reducing interest rates, and we have not actually seen signs that we have truly entered a recession, which will show up in employment data. There's focus on all these different sectors, but at the end of the day, it's all about jobs. And if the economy is adding jobs, if the number of folks going on unemployment remains very low, then we're not in a recession.
Okay.
And that's
so here's the chart.
Exactly. Yep, exactly. And so there's sort of two different data points I put a lot of weight on. The one on the left is the not seasonally adjusted initial unemployment insurance claims. And the reason I like the not seasonally adjusted data here is because weekly data is almost impossible to seasonally adjust. It just doesn't work well. All of our statistics are designed for monthly or quarterly data. And what we see here is having the week of the year on the x-axis is the number of initial claims that we've had each week so far in 2023, especially over the last 5 or 6 weeks, has been tracking the 2017 through 2019 average very closely. We had a little bit of a spike in the early part of the summer, and then with the failure of Yellow Corporation, that caused about an additional 30,000 initial claims to be filed. But we're tracking right now 2017 through 2019 really closely. Those initial claims numbers are far below where they were in 2014 through 2016 on average, and that was an expansionary period for the economy, albeit weak. We may not be quite as low as we were in 2022, but that was probably the strongest labor market in memory. And then on the right, what we have is what's called the U6 rate, which is the most expansive measure of unemployment reported by the Bureau of Labor Statistics. So it's not only people unemployed, but it's folks marginally attached to the labor force, plus individuals employed part-time for economic reasons. And right now that number is hovering around 7.1%. But historically, anytime we're below 7 or 7.5, it's a super tight, super strong labor market. The only two periods going back the last 30 years where we have that are the late 1990s, early 2000s, and then end part of 2018 into 2019, and then end part of, or basically 2022 through today. So we're not seeing that spike yet that we would expect if the economy were to be entering a recession like you see in 2001, and then certainly 2008 into 2009.
Excellent. All right.
Yeah, well,
So,
Bob,
yeah,
all I'd
go ahead,
say
Jen.
there, I mean, I accept Jason saying that, the plane hasn't landed yet, but in the US, the altitude of the plane is a lot lower than it is in Europe and the United Kingdom. So I think
What is
that's the
your
good news
assessment
for you
then?
guys.
When
Yeah,
will we know?
well, I think Jason put it quite eloquently when we were preparing for this. It will happen when unemployment is not rising, where employment is rising, and the Fed can cut interest rates. So, because inflation is under control, that will be the soft landing. We're not there yet, but yeah, you've definitely got your seat belts on, and what did you say? Your tray upright.
Yeah,
Yeah,
right. Put your seat in the upright position, fasten your
yeah,
seatbelt, and make sure that your table is safely secured and your laptop is put away in your backpack. So
yeah, absolutely.
excellent. So let's go back a slide here to talk a little bit about manufacturing and a comparison between the U.S. and Europe, and particularly Germany. So, Mandy, you want to go back to that slide?
Yeah, no, and what this is showing is really, and we've talked a lot about energy costs, and this really shows up here, thinking about, sort of the health of the U.S. versus Germany. Doing this comparison because these are two of the world's four largest manufacturing nations here. And on the U.S. side, we are in a manufacturing recession still. We really entered that kind of into late Q3, early Q4 of 2022. And we've seen a decrease in manufacturing activity of about 2% year over year, give or take. These data through August, the September data showed a slight uptick seasonally adjusted, but nothing really to get excited about. And that puts U.S. manufacturing activity about where it was in 2019. It has, for comparison. Germany, in contrast, on the left, has seen a much steeper drop in manufacturing output of, about compared to 2017, down almost about 6%, and that's on aggregate. And that's being pulled down by numerous sectors like motor vehicle production being down, machine tool production being down, but especially on the right here, really showing the effect of those energy prices is what we've seen happen on chemical production. So a key sector for both the United States and Germany. In the U.S., we've seen chemical output decline about 5 to 8% from the peak period we were at in late 21, early 22 recently. Whereas for Germany, it's a 20% decline in comparison. And that's just because the energy price spikes that we saw once Russia invaded Ukraine just made it uneconomical to produce many different chemicals. And so you saw that production either get slowed down and shifted to China, for example, by a lot of the German manufacturers who have massive facilities over there, or it was just pure demand destruction. And so this just shows the difference in the effect that energy prices have for very energy intensive sectors. And I think ties into John's comments that, while we certainly have not landed the plane yet, we're still at like 10,000 feet plus for Europe. Whereas in the US, we're probably at maybe 2,000 feet. We're starting to, we can see the runway, whereas we're not seeing the runway yet in the EU or in the UK.
So, does this give U.S. Buyers, in a sense, an opportunity because Germany is, is low and is looking for customers and trying to build back? Are there procurement opportunities? Is there some strategy that we should be, working some arbitrage or some taking Germany's issue right now and turning it into one of our advantages? Or maybe there's just more markets for U.S. Suppliers. I'm just trying to think of what this might mean to our audience of procurement professionals.
And so to me, the big thing is, especially as we think of chemicals, is the higher cost structure in Europe makes U.S. exports more attractive, even with the dollar being strong. The arbitrage opportunities get reduced because, the big chemical manufacturers, if they're producing the same chemical in the U.S. and Europe, let's say Dow sells something to someone in Europe and BASF sells something to someone in the U.S., if they each make the product, they just swap labels rather than transporting the stuff overseas. So the arbitrage opportunities get reduced by that. But the big thing I see for U.S. chemical manufacturers is this is a chance to potentially gain some market share. And you'll even see that if you look at U.S. pricing of, let's say, plastic resins, is during 2021, when there was such strong demand domestically, we saw the export price index skyrocket because you were only exporting if you could command a tremendous price premium. As domestic demand reduced, that export price index plunges down because those manufacturers then start to turn to the export market more. And so the big thing that I'm seeing from this is really a chance for U.S. manufacturers to possibly pick up some market share, given, European production is lower and is unlikely to rebound to those 2021 highs for a very long time.
Okay. So, John, what's your analysis? Yeah, go ahead.
Yeah, just the interesting point there, though, is what Jason said about European or German production going out to Southeast Asia and China, and the impact that has. Now, the Germans are very proud, and they don't like putting stuff outside Germany. I do a lot of work with automotive tier one suppliers in Stuttgart. But the interesting thing about chemicals is the made in Germany label, which is important for Karcher washing machines or BMW cars or even Marley pistons. Okay. As Jason quite eloquently illustrated, that is not quite as important for chemicals, and so it'd be interesting to see what the dynamic is if those chemicals are being produced at lower cost locations outside Germany, and whether or not that activity ever returns to Germany once it's been outsourced. So I think that's an interesting sort of third strand to what Jason was talking about, that maybe will play out over time.
So here we have also the big the giant economy called China, and they cut interest rates this year, holding steady under 4%, and they also have a very struggling real estate market, as I'm just reading even in today's paper. So since the Chinese economy is huge, what does this say about the global economy? And could they tip the scales one way or another, depending on which way they go and how they manage their interest rates and overall economy? What's our assessment of what might happen and how it might affect procurement around the world? John, why don't you jump in?
Yeah.
Oh, Jason, go, and then I'll come.
And I would say, comparing, let's say, the U.S. versus Germany in exposure, Germany is much more exposed to a downturn in China just because of the amount of machine tools and industrial supplies that Germany sends over there. The U.S., when we think about our exports to China, it's very much agricultural. It's pulp and paper and things of that sort. It is some industrial machinery, so there is some exposure for U.S. manufacturers in that regard. But a lot of what we export to China are things like semiconductors that are going to get put in finished goods that are then shipped back to the U.S. to arbitrage on the labor costs. So I would say Germany is certainly the more exposed of the two. You know, I think the challenge the Chinese economy has is not only is there a property crisis, for lack of a better term, and we need to see how this works out. But I don't think the Chinese government realized how serious Western companies were when they were going to start shifting production out of China. And certainly on the U.S. side, we have seen very substantial shifts to the rest of Asia and then Mexico as well. And so from an export side, I mean, I think there is 0.0% chance that U.S. imports from China, let's say on a TEU basis, go back to 2018 levels. Those days are gone. We've already reached max trade with China from a U.S. standpoint, or max imports for sure.
Okay. So can we jump ahead to John Glenn's slide here to talk about Vietnam and Asian trading, because this seems like it fits right in at this point. So,
Yeah,
man, if you can find that, and then John, can you talk about it?
So the point is, you've seen a massive increase in exports from Vietnam. Okay, in the last 10 years, 10 years. So this is, billions of dollars per month on the right hand scale. Okay, biggest trading partner though is the US. They do about just short of 100 billion, but to the point as well, they're also re-exporting a lot of electrical industrial machinery back into China. So China itself is outsourcing some of that activity. But then, and I think this is important in terms of scale, we're looking at a Vietnamese economy now, which is one of the 21st biggest exporting economy on the planet, exporting, around 400 billion, 350 to 400 billion US dollars a year. But that only equates with current Mexican exports into the US alone. Okay, so we're seeing a readjustment of activity around Southeast Asia as people seek out new low-cost locations, and then we're seeing onshoring of activity in the maquiladoras in northern Mexico, with massive cross-border trade, which is being picked up in the exports. And then Jason is in the sweetest spot to talk about this, but presumably the volume of trucking, at least for the people that I work with, that's crossing that Mexican border into the US as those goods are trucked across, has increased exponentially. So that's the pattern that sort of Jason was alluding to.
Yeah, can we see your next slide here?
So the next slide just picks up the light green is US trade with China. Obviously, the increased tariffs on Chinese exports, the fact that Jason is saying that we've reached sort of maximum trade with China. Hey, far be it from me to comment on what's going to happen in the US. I might just put a caveat on that in the medium term. China will now, I would say, start to follow the sort of pattern of a South Korean industrial development. Its manufacturing activity will go further upstream, more higher value added, and as that higher value added stuff becomes, more and more internationally competitive, then we might see a return to China being the workshop of the world, as it were, for that kind of activity. And then just a massive increase in Mexican trade. I have to say, I'm aware of, the whole NAFTA initiative. I'm aware, obviously, of the type of work that organizations that I am involved with are doing across that Mexican border. I wasn't aware of the aggregate level of activity trade with Mexico. It's truly phenomenal.
Yeah.
Jason?
Yeah, no, yeah, just to put some numbers on it, the two ways I like to look at trade with Mexico is one's inflation adjusted trade. That's up right now about 20% for the first half of 2023 relative to the first half of 2019. A lot of that is motor vehicle and parts production rebounding so strongly here in the States. The other is there is data from the Bureau of Transportation Statistics on the number of loaded trucks that cross into the United States from Mexico through each border crossing. And that data is also showing about a 20% increase from where we were in 2019. Now, that does put us sort of on a smooth trend line of growth. I think the challenge that we're going to run into with, the reshoring efforts to Mexico is just what is the upper limit to the amount of capacity, manufacturing capacity, essentially, that can be shifted to Mexico over a short-term basis. And I think that that's where we'll start to see potentially some sort of strains reached. And as we see more industry moving to Mexico, that'll be a huge opportunity for some parts of U.S. manufacturing. For example, we run a tremendous trade surplus shipping a lot of specialty chemicals and plastic resins to Mexico. So there is a huge opportunity there, again, for the chemical manufacturers to take advantage of, these readjusting or realignment of trade patterns.
Okay. So keeping along this idea of reshoring, shifting supply chains, we had a slide here, private investment in manufacturing structures. If we want to, man, if you can find that, M7, there we go. And you recently wrote about this, Jason, in a LinkedIn post. And what does this say about reshoring or domestic manufacturing? It looks like there is a huge spike since 2020 in investment in manufacturing. Where is this coming from? Is this an anomaly, or are we seeing the start of a trend here?
Yeah, so what these data are, this is inflation adjusted data on basically spending on building manufacturing plants in the U.S. And the BEA has this data back to 1958, and even adjusted for inflation, 2023 is by far the highest year of all time. Now, here's the caveats, though. This is all due to building of semiconductor plants as well as EV battery plants. So it's entirely based on two industry sectors, computers and electronics, as well as electrical equipment, appliances, and other electrical goods. And so if we're thinking square footage being built, I certainly don't believe we're at levels that this is conveying, because the challenge is that the semiconductor plants, the price per square foot is outlandish compared to, let's say, a food manufacturing facility. So it's good news, certainly, for, I'd say companies that are supplying those industries. But from, let's say, a freight volume standpoint, it's not necessarily as exciting. And I do think there is some concerns of almost crowding out of other, manufacturing spaces, let's say food manufacturing, which if I'm a trucking company, I care a lot more about more food plants being built than I do semiconductor plants.
Sure. There's not a lot of weight in semiconductors or
Nope.
volume. Yeah. So, are you seeing something that's similar to this at all in the UK and in Europe? What is the sort of reshoring idea in other places around the world? Are people trying to reshore, are trying to shorten their supply chains? We see it obviously in the United States, but what's going on around the world?
We're not seeing anything as pronounced as this. Definitely in the United Kingdom, and I would say in Western Europe, no. What we are seeing is, if there is reshoring, and significant reshoring is occurring, is into Eastern Europe and into the Mediterranean to a certain extent. So nothing as pronounced as this, although I have to say that looking at Jason's graph has made me want to go away and have a much closer look at the data, because that's a phenomenal effect. But I think the point about crowding out is a significant one as well. Okay, because the extent to which this does crowd out other sectors of the economy is something that obviously procurement professionals have got to be aware of.
Excellent.
Yeah, and I was just actually checking in the background, and this is from my buddy Joseph Politano. Factory construction in Germany is actually on an inflation-adjusted basis declining. So we're seeing not a complete and total opposite of what's being reported here in the U.S.
Wow, excellent. So I'd like one more time to ask our attendees, if you have a question, this would be your time to put it into the chat stream, and we would be happy to answer it. So if you have we have a couple of minutes to do that, go ahead and go in there. And if not, then John, what's your final thought here on what advice to procurement professionals? What are the 1, 2, 3 thoughts that they should be leaving here with as they go on to do their work?
Yeah, so in our prep session, we said that the macroeconomy is relatively boring in the sense that we know where interest rates are, we know where they're likely to go. Inflation is going to be under control probably into the end of next year. GDP growth is going to be unspectacular. We're going to remain at or very close to full employment. Okay, so that's where it's at. I think what we need to, as procurement professionals, is we need to focus on the microeconomics of what's going on. So what does that mean for volumes? What does it mean for prices? What does it mean for lead times in the markets that you are operating in? So you now have to come away from what's happening in the economy and aggregate to the microeconomics of your own market. What are the products that are selling? What segments should you be going after? What geographies should you be going after? And then what does that mean for your procurement decisions? Okay, and we've talked today about bullwhip effects and running down of excess inventory and additional inventory costs because of high interest rates, and that being the sort of grunt and grind of procurement. That's the daily challenge that procurement professionals face. But now they have to be much more attuned to the realities of what is being demanded and what's required of them in order to supply that effectively and efficiently.
It sounds almost like we need to put the blinders on a little bit. You don't want to be distracted too much by what's happening around the world. You have to pay some attention, but every sector is different, and you should look at your own situation and look at that first. Is that kind of what you're saying?
Yeah, and if we are looking at macroeconomics, if you are sort of taking the blinders off to a certain extent, it's the movement in trade patterns that we've talked about. It's different sourcing realities. It's onshoring, reshoring, nearshoring. Call it what you will. And again, we've not spoken about it, but I've got not statistical evidence, but definitely evidence of trade of Chinese organizations moving into the maquiladoras and creating maquiladoras in northern Mexico. So part of the nearshoring might actually be with partners from Southeast Asia. So those realities have to be looked at.
So, Jason, before you give your final thoughts, I realize we have one more slide from you on consumer behavior, because consumer behavior does drive the U.S. economy, and there still seems to be a lot of worry about affordability. So is the perception of inflation worse than the reality? I get the sense sometimes that consumers are not complaining about the prices jumps from last month. They are remembering prices from 4 years ago and thinking inflation is terrible right now. So that sounds to me like that could be affecting their decisions and the confidence they have in making purchases. So especially big ticket items. So where do you see consumer spending and consumer confidence?
Yeah, so I put effectively 0.000 weight on things like consumer confidence surveys from the University of Michigan as an example. And I'm not just saying that because I'm at Michigan State and we're trained to hate University of Michigan, or the fact I'm from Ohio State, which from the state of Ohio, for those of you who are international, that is like the ultimate arch rivalry right there between different states and on this side of the pond. But the problem is consumer confidence tanked in 2020, yet we had record retail spending by June, and then that just continued to become even more pronounced. So I look at it as how are people actually behaving with their wallets rather than how they're saying they're behaving. And right now, what we're seeing is that retail sales are not declining in some type of manner that is consistent with consumers really pulling back spending. We just had the September data, which September is a month that we always have to put a caveat that sales always drop from August. So a seasonally adjusted gain really means sales dropped less than expected, but the data was much stronger than most folks predicted. And really what's happening is we're just moving kind of horizontal right now, but we're moving horizontal off of a tremendous spike in sales that really took place in the back half of 2020. And then in 2021, there's two really high data points for those folks in Europe. That's when we had the largest fiscal stimulus efforts in U.S. history of handing most adult Americans $1,400 checks and watching what they did with them. And so right now what we're basically seeing is it's moving horizontal, which is kind of odd. Normally we would be trending up, but really what we're doing is we're approaching that long-term trend line in terms of how we're spending on goods. And so we just had Bank of America released a major analysis the Wall Street Journal picked up on, showing that the median checking and savings account across all income cohorts, the median savings account's 50% higher than it was before COVID, savings and checking combined for each different cohort. The BEA's revised data on what's called personal savings, which doesn't actually mean data going into a bank account, just to be very clear. It's sort of a kind of special definition. But with the revisions, the abnormal savings accumulated in 2020 and 2021 appear much more robust than what we previously thought. And so Bank of America concluded the consumer still has quite a bit of dry powder. And so it just doesn't seem like we're, again, in a position where people are going to stop spending right away. Yes, we have higher total credit card debt. Looking at debt on absolute terms is effectively meaningless. It's one of the worst things that mainstream media outlets like to do. You have to look at debt normalized by disposable income, or you look at delinquency rates or bank charge-offs. Yes, we're seeing an increase in charge-offs. We're seeing an increase in delinquencies. But this is effectively bringing us back to 2018, 2019 levels. We were abnormally low in 2021 when we had all this financial stimulus coupled with people still not being able to spend on services. My one comment to anyone who says we're in a recession is then explain to me the Taylor Swift Eras Tour. You don't have by far the biggest concert tour in history in an economy that would be in a deep recession. And I think if we've learned anything over the last year, it's, I remember, Bob, we're doing these, talking about these things back more than a year ago. I mean, back in like June of 2022, where the mainstream prediction was we're going to be in a deep recession by 2023. And that did not materialize. And so I just tell people, look at the jobs market, look at, consumer spending. If you're not seeing spending decline tremendously, and we're not seeing unemployment rates increasing or initial unemployment claims increasing, at least on this side of the pond, we're not in a recession. And so we're not in a recession right now. Q3 GDP growth is going to be positive. Q4 probably won't be quite as positive, but the U.S. economy is not in a recession. If we can make it a couple more quarters without being in a recession and inflation starts getting back towards 2%, and the FOMC for sure says we ain't raising anymore, and maybe we're going to start thinking about cutting, then we can probably say we did have a soft landing. And, you know, a lot of people are skeptical of soft landings, but we had one in the in the mid 1990s, about 1993, 1994, 1995. We had a similar situation. Fed really raised interest rates quickly, but the economy didn't go into a recession. So there are historical parallels for this.
Excellent. Yes, and if you want to define discretionary income or discretionary spending, I would say a ticket to the Taylor Swift concert might be a very good definition. And that's no disrespect to Taylor Swift or the tour or the quality of the show, but those are big ticket items, especially for people who flew and traveled to places to see that concert, and especially knowing that if you just hung out like I am, waiting for the concert movie to come out, and which just did. I think I'm going to see that concert for a lot less than people who saw it live. But again, no disrespect to that performer or the people who did spend that. But that's a very good indicator of people do have money to spend, discretionary income, and they are spending it. So that's fantastic. So just before we leave, did you have any thoughts at all, John Glenn, about consumer behavior, especially in other parts of the world? I don't want to miss that if you had something to add to the conversation.
No, just quickly. Well, first of all, I'm the only person on the planet who doesn't know what the Eris concert is. Going into the cinema last night, it was being advertised, and I had to ask my wife, what the hell is this Eris thing? But she explained to me very quickly. Yeah. But anyway, so notice there, Jason talked about the median consumer, and I think that's really the person that we have to concentrate on here, particularly in the United Kingdom, where there's a lot of talk about a cost of living crisis. That cost of living crisis exists at the bottom end of the income distribution, which is terrible for those people who are in it. It's a really tough place to be. But in the aggregate, the whole economy is doing a lot better than we expected. Again, we're not quite as good as you, but we could well avoid a technical recession into the end of this year. The consumer is robust. Savings are high for exactly the reasons that Jason articulated. The consumer is coming back and is out and is consuming and consuming quite robustly. The caveats there are interest rate increases, particularly on the property market, haven't had their full impact yet, and there's a probability that they could have a higher impact there. But again, this pent-up savings in an economy which hates having a high savings ratio. A savings ratio, if it's 2 or 3% in the UK, we think that we're saving, a vast amount of money. And I think it went to 16, 17% during COVID. It's crazy. So, consumer is robust. We just need to get our economies moving. And Jason has pointed out where the issue for us is in Europe is with manufacturing. That's not as much a problem in the United Kingdom because of the balance of services and manufacturing. Now, in our economy, it is a big problem in economies like Germany. And then the only other thing that we've got over here, and I didn't mention it in the pre session, was that we have a big problem with fiscal drag on our taxation system. We haven't had an adjustment of tax bands for 6 years. So we've got about an extra 6 million people now being brought back into taxation. So again, that's hitting a cost of living crisis at the bottom end of the income distribution. But generally, the retail spender and the consumer will hold up.
Excellent. So Jason, I'm going to give you 1 minute for any final thoughts.
And right now we're actually entering, I'd say, the first time in 3.5 years where economic news just ain't that exciting anymore. So I'd tell everybody one of the big things is don't read too much into slight month-over-month movements. Right now, we just seem to be kind of a steady state situation. The biggest thing on this side of the pond is, again, jobs. If we start to see initial unemployment insurance claims go up, that's when we're likely looking at a recession. But right now, I'd say for procurement professionals, it's watch that. It's watch those producer price indices to see where costs are moving. But it's kind of entering a boring period. It kind of feels like we're back a little bit into the doldrums of 2019, where there just wasn't that much happening. And so just keep monitoring the markets. But fingers crossed, we can avoid a actual recession, and hopefully the back half of 2024 is a better looking year from a demand standpoint, and then 2025 feels a little bit better again.
Excellent. Well, thank you both for once again your insights and very learned and reflective analysis of the situation. Appreciate all the charts and graphs, and I hope everybody could follow along with us. So thank you very much. I'm Bob Rosbeck. This has been Global Sourcing Insights from CIPS. Take care.